Hello, today I'm here with Steve Boeckmann, Certified Financial Planner and Tax Planning Certified Professional, co-founder of BW Wealth Management and founder of BW Tax Strategies. Welcome, Steve. Great to see you.
Thanks for having me.
Today we're talking about a question that sounds simple but can have a huge impact on your retirement. Steve, I hear you ask every client, how do you want to be taxed? And what do you mean by that?
That's right. And it surprises people at first. But every dollar you earn, save, or invest will eventually be taxed. The real question is, when? With proper planning, you have more control over your taxes than most people realize. That's where the three tax buckets come in.
Okay, I like where this is going. So what is the first tax bucket?
So the first bucket I refer to as the tax deferred bucket. Think of things like your IRA, your 401k, 403b, 457, SEP, and simple IRAs. Unfortunately, most Americans have the majority of their savings in this bucket.
Unfortunately, I thought it was a good thing to save. Why do you say unfortunately?
Of course, savings is always a good thing, but there are disadvantages and advantages to saving this way. You see, the advantages are you don't have to pay taxes now, so you get the deduction now. The money gets to grow tax deferred. The disadvantages are every dollar you take out of these accounts in retirement are taxed as ordinary income, meaning, if you're in a 24% tax bracket or a 32% tax bracket, you're being taxed at those rates. Also, the IRS limits the amount you can invest in these types of plans.
So the IRS just waits until you are older to get their cut?
The way I like to refer to this is a seed or crop analogy. So with your retirement accounts, you are taking a tax break now, but all that money is going to grow and grow and grow, and then when it becomes a quote unquote crop, then you're paying taxes on the larger amount.
Okay, so how does it end up being that the tax deferred bucket is where most Americans have their savings?
That's a great question. And the first thing is, well, because it's easy. Most people's jobs or companies offer them a 401k, so it's easy just to defer some of your income into the 401k for retirement. And especially if they do a match. We want to encourage everyone to do a 401k up until that match at least, because that's free money, right?
Absolutely, yeah.
That's the best kind. It's also great for high earners who want to take an upfront tax break now. So if you feel like you're going to be in a lower tax bracket when you retire, then it does make more sense to utilize these types of investments. But the downside is you could be creating a large future tax bill if that's where most of your money sits.
I see. Okay. All right. And what is the second bucket?
The second bucket is the tax-free bucket. This is my favorite of the three buckets. So think of Roth IRAs, Roth 401ks, 529 plans, and HSAs. And if structured properly, cash value life insurance. So in this bucket, you pay the taxes now on the contribution, but the money grows tax-free and comes out tax-free in retirement if done properly. So again, back to the seed and crop analogy, you're paying taxes now on the seeds, but as that grows into this huge crop later on down, all that money is then tax-free. And that's a huge advantage.
Yeah, that is a huge advantage. Wow, so no taxes later.
Correct.
Okay, well, what's the catch on that then?
So the downside is there's no upfront deduction. And there's income limits on your contributions. So you can't just put whatever you want into these types of investments. But strategically building this bucket can make a huge difference later in life and lower your overall lifetime taxes.
Okay, that makes sense. All right, let's go on to the last bucket.
Okay, the last bucket is the taxable bucket, and I call it taxable because they kind of get you coming and going.
Sure.
With this, think of your bank accounts, your brokerage accounts, stocks, ETFs, mutual funds, CDs, things held outside of your retirement plans. So with this, you're going to pay taxes on the money that you earn to invest, right. And then you're going to pay capital gains when you sell an investment. It could be long-term or short-term, as well as dividends that you're going to pay taxes on along the way. And you'll get a 1099 each year for the amount of taxes that you owe for that. So you're kind of getting tax coming and going.
Absolutely.
The advantages to this one, though, is that there's no limitations. You can invest $1 million every year if you want to. The government doesn't restrict any of the, it doesn't have any restrictions on how much you can, quite frankly, because they're getting their taxes all along the way.
Oh, that makes sense. Okay, yep. So on this one, that makes sense. So you're paying taxes as you go.
Exactly. But the upside is flexibility, there's no age restrictions, there's no penalties, and there's no liquidity and no IRS restrictions.
Full liquidity.
Yeah.
Okay. So why does all of this matter?
So, because most people, without realizing it, have about the vast majority of their savings in deferred accounts. What this means is every withdrawal in retirement increases your taxable income, and that can push you into higher tax brackets, even trigger IRMA surcharges, which, if you're not familiar, is an increase in your medical premiums, which can be very extensive.
Right, I think we did a video about IRMA.
Yes.
Yeah. Okay, so the goal isn't avoiding taxes, it's controlling them.
Exactly. The smart strategy is diversifying across all three tax buckets. That way, in retirement, you get to choose where your income comes from each year. You control what tax bracket you want to be in. You manage the Medicare premiums, and if you're and you're not leaving your tax future completely up to the IRS.
That's powerful. It's just one simple question, how do you want to be taxed, but it can change the entire landscape of your retirement.
Yeah, it really does. Tax planning isn't just about saving money, it's about building flexibility and control for the future.
All right, Steve, well, thank you very much. Thank you for breaking it down for us today.
Well, thank you for having me.
All right, if you found this video helpful, like, share, and subscribe below. Have a great one.